Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Asian equity benchmarks sinking as China discusses front-loading stimulus to counter the tariff impact and stabilize the markets. But right here, a historic close setting us up for a historic open. Futures selling off on both sides of the Atlantic as the S&P 500 approaches a bear market. And EU ministers meet in Luxembourg today to prepare a response as the leaders of Israel, Vietnam, and Taiwan engage with the White House.
OK, let's talk about these markets. Monday morning, ugly session, obviously Thursday, Friday, ugly sessions. We get into Monday and it continues. It's risk off in equities. You can see it ripping across Asia, partly a response to last week. But there you go. Euro Stoxx 50 futures this Monday morning down by 4%. But you've also got S&P futures below 5,000 down by 3.6% right now. The VIX opens at 8:15 London time. That's going to be a key moment this morning to watch out for. The US 2-year is catching a bid. That is obviously something you want to pay attention to and continue with. It's going to be interesting to see what happens with that trade. We obviously heard from Powell Friday. We had payrolls Friday. But Trump speaks twice today, folks. That is going to be critical. We have a massive, massive opening coming up. The opening trade starts right now.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world.
Trump is not blinking. Two big events coming up today. He's going to speak to some basketball players a little bit later on, but critically, he's also going to be speaking to Netanyahu. We'll talk about that in just a moment, but let's talk about where we are right now. At the moment, Kriti, it is an ugly get-go to this Monday, following an ugly Thursday and Friday. Trump is not blinking. The market, risk assets heading lower.
They're heading lower, a 17% drop in the S&P 500. That's where we are. We're eyeing bear market territory. This is enormous as investors around the world deleveraging, getting to cash. It isn't even the tariff policy necessarily that's hitting this. It's the fact that you are seeing such volatility with the messaging, the execution risk. In the words of Paul Krugman, the famous economist, he's saying, look, tariffs don't cause recessions. It's the policy uncertainty that comes off of them that do, and that people just don't know where to invest. Companies, corporations, even just market participants.
Market participants are key in this kind of environment. I think you can park all the other noise, plug Trump into it, plug the European policy response into it. But this morning, it is about how this market is positioned. It's about what is happening with liquidity. It's what is happening in terms of what you can sell, what you can't sell. It's all kinds of factors that are coming into the market that weren't there before. The market is now being stressed. I've been through this a few times, and you start to see the unexpected. And we're beginning to see some of that beginning to emerge already. I think the VIX opening at 8:15 is going to be really important this morning. It massively spiked higher on Friday, 50% move. Does that continue? What does that tell us about where we're positioned right now in terms of the market's fear gauge? There's a lot going on this morning, and I'm just kind of wondering what is signal and what is noise here. It strikes me that the only signal in the market at the moment comes from Trump, comes from policymakers in Europe, and comes from the market's kind of measure of liquidity. Can it trade this, or do we start seeing forced elements within this market beginning to show up?
I'll add the other piece of this is that the markets don't have, it feels like, the safety net of Jay Powell right now. They don't have this idea that if a recession hits or if the economy slows down in a very big way, which, by the way, on Friday, Jay Powell said is not where the data shows right now. Right now, the jobs market is still strong in the States. The economic resilience is still very much there. But he's also still got his eye on inflation. So if growth does ultimately become the story and inflation is still higher, Powell's not coming to your rescue.
The market doesn't believe Powell, though.
Yeah.
Absolutely not. Four cuts are priced in. So the market does not believe Powell right now. He says, yeah, I'm worried about inflation. He's worried about the risk being greater off these tariffs. But the market's got 4 cuts priced in from Powell. That's the knee-jerk reaction. That's history. Powell will cut if the market gets more stressed from here.
But that's where you need that kind of message of comfort almost from the Fed that you're not getting. Arguably, you're getting it from other parts of the world, though.
Are you? I'm not sure you are.
Well, an idea of the stimulus to support the selling off, the idea of markets coming to the rescue.
The problem is, though, that can exacerbate the situation. So the talk out, so Asian equity markets have been absolutely slammed overnight. Unsurprising. There is a kind of mechanical process that works here. But clearly there has been, Asia in some ways is the centre of gravity in terms of the hit that we are going to see coming through from the Trump tariffs. So it's unsurprising that we're seeing Asian markets coming down. But the Chinese is talking about stimulating. That tells you that they are not going to blink. OK, that's not positive in terms of the overall trade war narrative. There's also talk this morning that you could see devaluation of the yuan. You get that, the White House is going to respond. That is a direct response, a direct threat to this tariff policy. Reduce our currency, make our goods easier to export. We're going to get around your tariffs that way. That may not go down well with Trump and his inner circle.
Yeah, it's fascinating. You mentioned the China piece. We've got that devaluation chart on the screen at the moment. There are other parts of this kind of Asian economy as well that have been hitting American companies. Nike, for example, I thought was one of the main highlights. A lot of that not coming from China, but because of Vietnam. And if you'll remember back in the first Trump administration, a lot of these Fortune 500 companies, S&P 500 companies, if you will, moved their supply chains out of China, one for the first Trump trade war, then because of the COVID response, to the likes of Vietnam, India, et cetera. We should mention, though, that Vietnam is already doing kind of what Donald Trump wanted, which is offering to remove all tariffs from the get-go. We'll see where those conversations lead. Yeah,
going to see the Netanyahu conversation. We'll come on to that in just a moment. Japan is taking a big hit here. Is the BOJ sidelined? Are we done with hikes in the BOJ as a result of what is happening here? You've got to price that back out. What happens with the Chinese, with the Japanese currency, I think, is also interesting. It's interesting what is happening with the metal story. Look at what is going on with Australia. Metals are all over the place this morning, trying to figure out what they're going to do as well with this trade. So I think I hear what you're saying about the Chinese story, the Asian story potentially being a positive. I just wonder whether it's going to further exacerbate the situation a little bit later on. And I wonder whether the Europeans have the potential to do that as well today.
I think there is a argument here that there are, at least when it comes from an investment point of view, the uncertainty is simply because so many of these companies, have diversified, not just in Asia, but right here in Europe as well, and they still don't know how to proceed from here. So if the argument is moving, or if the end goal here is to move your manufacturing back to the United States, do European companies need to be thinking that as well? Do they need to be moving their manufacturing back to Europe? Is that where things are headed? I wonder if that's something that's discussed today in Luxembourg.
I think the bigger picture here, though, is how does Europe respond? Are we going to see division within Europe? Are we going to see a concerted approach? Are we going to see a coordinated approach between the European countries? If so, what does that coordinated approach look like? Are we going to see the Europeans being aggressive, or are they going to tiptoe into this and hope for talks that will deliver maybe a better outcome? What's going to happen on the services side? What's going to happen on the digital side? What is going to be the response there? The French clearly are looking for a punchy response here. Are others going to go along? And I think that we may get some indications. Ollie Crook's going to be joining us shortly to give us an indication on what we can look for from this meeting today. But if the Europeans come out swinging, you saw the response to the Chinese coming out swinging on Friday. Do we see another leg as a result of what we get from the Europeans?
You mentioned our friend Ollie Crook, of course, is going to be in Luxembourg. He's going to have an interview and bring it to us shortly with the finance minister, the economy minister of Spain, Carlos Cuerpo. And I think I'm having a little bit of deja vu here, because when you have this united European response, there are cracks that emerge. And Spain is a good one example. Italy is another. They're talking about a less aggressive tariff response. But this is quite similar to the conversation we had when the EU was trying to target tariffs on Chinese overcapacity in EVs, where you did see these divisions from these major economies. And right now, when it comes to the tariff response to Washington, it is very much a core versus periphery story. And I think that's going to be one indication of how world leaders perhaps respond.
Trump was watching the golf over the weekend, which I'm sure he enjoyed greatly. He's going to be meeting some basketball players a little bit later on. Maybe he'll talk about tariffs at that meeting, I don't know. But the Netanyahu meeting, I think, is going to be fascinating. Israel comes out and says we're going to reduce all tariffs, but Trump hits them hard. And you wonder whether Netanyahu can get anything else out of this meeting, and whether there's a first crack that appears in the Trump facade on tariffs, because he's basically calculated all of this based on deficits. Will Netanyahu be able to get anything out of Trump today? And if he does, that can be taken as quite a positive signal for the markets.
It can be. It's a litmus test. It's a little bit of a green light to some of the other peers. But look, there are politics around the Middle East as well. And I think there is a key piece here of when you look at that countries list, even some that did have massive trade deficits that with the United States have political reasons where you did start to see the tariff kind of come down. The UK is one example. You saw Turkey as another example. So 100% that we'll certainly see if Israel kind of paves the way for the likes of Vietnam, Taiwan, and several others that are looking to engage rather than respond immediately. I
think that meeting's at 2:30. We'll look for that a little bit later on, 2:30 Eastern time. What else we got coming up for you on the show today? We're going to analyse all of this. We've got some great guests lined up. Barnaby Wager, UBS's investment bank chief strategist, perfect person to talk to as we work our way through these markets. Sylvia Adania, Barclays chief European economist. How should Europe respond? What kind of economic effect are we going to see? Ben Gutteridge, Invesco portfolio manager, joining us a little bit later as well. Elvira Fabi is going to be joining us. Jacques Delors Institute, geopolitics and trade specialist. Get a take on that. We'll work out exactly what is happening in terms of how the Europeans are going to respond, how the Chinese are going to be responding as well.
Absolutely. I mean, some fascinating conversations coming up over the course of the next 2 hours. Let's talk about what's coming up during this week, because already today, the story of the day is how these markets are going to be reacting and what these reciprocal tariffs from, or I should say responses from other countries around the world actually looks like. Of course, we're going to get an early indication, as we discussed, from the EU trade ministers meeting in Luxembourg today. But then you've got a series of data points throughout the entire week. I'm going to look at one here on Tuesday that I think is going to be quite interesting, which is U.S. small business optimism. Yep. Now, this is a little bit delayed, so in that we're getting the data after perhaps the actual initial kind of counting was taken. But note that Russell futures are down this morning by a whopping 4%. So already you're seeing some of the small business concerns, which in theory should be the opposite trade, kind of getting hit. You just have several other data points as well. CPI numbers, of course, on Thursday are going to be a key piece of it. Does it even matter, though? Does the data even matter this week, from CPI, PPI on China in the United States, the jobless claims? Does any of it matter ahead of those bank earnings on Friday?
The guidance out of those bank earnings are going to be really interesting. I think what they say, what people hear from those banks, I think, is going to be important. The data, I agree, at the moment we're a bit of a hiatus on the data. The data is in some ways too old to give us a sense. The hard data is too old to give us a sense of really where we are. What is the Fed looking at right now? How is the Fed analysing this? As you say, Powell was focused on inflation Friday. How quickly could that change if the growth concern significantly weakens? At the moment, the labour market is holding up. Yeah. But when the labour market cracks, it cracks and cracks fast. But
this is the argument, right? This is the argument that I think a lot of people are seeing in Jay Powell 2.0 from Jay Powell 1.0, which is right out of the gates in the first Trump administration when this kicked off. He went out and said, we need an insurance rate cut. Yeah. You are not seeing that messaging this time.
Didn't have inflation to worry about at that point. I think that's the critical factor. That's the big difference between then and now. What else do you need to know this Monday morning? Let's run you through some of the other stories we're watching. In Paris, thousands of protesters gathered in support of Marine Le Pen Sunday. Speaking at the rally, the French far-right leader vowed to fight what she described as a, quote, political court ruling that has barred her, for now, from running for president. Le Pen was convicted of misusing money allocated to pay aides when she was a member of the European Parliament. She used EU money for domestic purposes in France, effectively. In the United States this weekend, there were also large, this time anti-Trump protests in cities across the country. Protesters took to the streets to voice fears over civil rights and call for an end to Elon Musk's efforts to downsize the government. And President Trump says that China's objections to new US tariffs stalled a deal to sell TikTok and keep it operating in the United States. Trump extended the deadline for the sale of TikTok's US operations for another 75 days. ByteDance says any agreement would need to be approved under Chinese law.
And coming up on the program, we're going to dive more into these markets. Oil continues to slip while tariff realities begin to weigh on the metals picture. We're going to dig into the commodities story and what the next trade may actually look like. Plus, European futures pointing to more pain for the equity markets amid the global rout. Stay with us for the opening trade in just about 45 minutes' time. But up next, Spain's economy, trade and business minister Carlos Cuerpo joins us from a meeting of his European counterparts in Luxembourg. U.S. tariffs and the response to them at the top of his agenda. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. We're just about 45 minutes away from the opening trade. A sea of red when you look at the futures picture. Take a look at this, a massive drop here. Look at 4% declines as much as in the futures picture, even 5% on other parts of the world. Now, this is going to be crucial here. This is all about what an international response to Donald Trump's tariff agenda looks like. That is the topic at the EU trade ministers meeting in Luxembourg today to discuss that very response. Let's go straight to Oliver Crook, who standing by with a special guest. Ollie.
That's right, Kriti, and that response begins right here in Luxembourg, where EU trade ministers have gathered in order to figure out a way to collectively respond to Donald Trump. And we're very pleased to be joined now by the economy minister of Spain, Carlos Cuerpo. Thank you so much for your time this morning. So much to talk about. Let's just begin with what the correct approach is from the Europeans on this. There are different views about going hard, going soft. What do you think is the right sequence here in the conversations with the United States?
Well, first, I think that the message that EU leaders must send is a message of trust, of confidence in very turbulent days where everything is around uncertainty and more tariffs, negative messages to citizens and firms. We need to keep on a positive message to our citizens, telling them that we will help them, that we will support them in these, under these days of tariff or trade conflict. And Spain has reacted very quickly. We did put in place a safety net for citizens and firms of 14.1 billion. Barely 12 hours after the announcement by the Trump administration, we think that there needs to be also an EU leg to this support. Citizens and firms at the EU level need to understand that the EU will protect them. And then, of course, going ahead, we need to also send a message of confidence to trading partners, including the US. We're open to negotiations, we're open to trade, but we will not be naive.
And so in order to not be naive, you need to have a sort of credible threat to reciprocate, or whatever the word is, we're going to call it, to the United States. Now, what is that? Where do you see as the point of leverages? What are you prepared to discuss today in order to respond to the United States?
Well, there'll be discussions first on the tariffs that were already in place a few weeks ago on aluminium and steel. And there is already, as you know, a preliminary list of products that can be also taxed with duties, with import duties by the EU. We will be discussing that specific list, but we will also be discussing the second step, the potential reaction also to what was announced 2 weeks ago on cars, the tariffs on cars, but also what was announced last week with these so-called reciprocal tariffs.
And so what are the correct responses to that? Because, of course, there's a limited amount that the European Union can do on goods. That is part of the reason that Donald Trump has imposed these tariffs. There's a $200 or so billion trade deficit in the favor of the Europeans. Are you looking at targeting potentially U.S. tech companies, services taxes? What are you thinking?
Well, again, I think we have to somehow avoid taking out of the table any instrument. We have the proper tools, the necessary tools to respond. So none of them should be discarded at this point, but we need to keep on sending a message of being open to negotiating with the US, but we need them also to be able to negotiate. We need two to tango.
And Macron has said basically he's discouraged European businesses from investing in the United States. Is that a sentiment that you echo?
Well, I think that's, we don't even need to do that because I think business people and firms will be discouraged by all this uncertainty at this point. The investment decisions, they're medium or long-term decisions, so they need to understand that we need to lower this uncertainty and give a message of trust. And from the EU, that's what we're doing. We're sending a positive message of stability, of trustworthiness, and that's what we expect that will actually increase investment in the EU as well.
And I'm sure you, just like me, have been listening to a lot of Donald Trump over the last few days, Howard Lutnick, Scott Bessent. Does this sound like a U.S. administration that is dying to do a deal? Because it doesn't to me.
Well, we have to remain a bit cool-headed, if I may say, very practical and engage with our peers.
When we think about the goals that they're trying to achieve, which they've said very explicitly is reshoring of industry and these sorts of things, does this give you a sense that they seem to be wanting to let their allies sweat a little bit? Well,
you know, we've been in this quest for strategic autonomy, all of us, for the past few years. And from the EU side, we understand that there is also an open side to this strategic autonomy quest. And that's how we want to go forward. I think it's compatible to keep ourselves open to trade and even to reinforce our relationship with the US. It's a very strong one. 4.4 billion euros actually are going across the Atlantic on a daily basis in terms of goods in trades and of trading goods and services. We need to reinforce that. But having said that, of course, we need to be able to respond to whatever threats would be on the side of the US or any other country.
And what concessions are you thinking about potentially presenting to the Trump administration? Would you be lowering tariffs? What other sort of vehicles? Because he's very obsessed with the non-tariff barriers. Do you have a clear idea of what those things are that he'd like to see changed?
Well, again, we will be engaged in those conversations on an honest basis, trying to understand what their concerns are, specifically, as you said, on non-tariff barriers. And then, from then on, what we want to do is to actually achieve a fair and balanced deal. And so, from that point of view, the EU will engage constructively.
And I'd like to also get, because you obviously also manage the Spanish economy, you've also, there's been advocacy of basically establishing an EU fund that would basically be funded by the tariffs collected from the United States in order to support Spanish industry, or European industry, but Spanish industry. What industries should that money go to? What are you looking at? Where do you see the pressure points arriving in Spain?
Well, I think it's, first, the EU dimension is key when we discuss actually how to respond to this. We need a new umbrella to protect our most affected sectors or industries. And actually, why? Because first, the EU has competence in terms of trade. The EU will get the revenues if there are import tariffs as well. And then I think citizens, as I said, and firms need to understand that the EU will protect them. We need unity in the response. So then again, we will have to see what sectors will be finally most affected, and those funds will need to be redirected to them.
Which do you anticipate right now, just as watching the Spanish economy, you think will be most effective?
Well, looking at EU overall, we know that the automotive sector will be one of them. Let's see what happens finally with pharmaceuticals. We know that something is coming. We don't know exactly when and how much will be in terms of tariffs for that specific sector, but it's important for Spain and other EU countries. And we need to go one by one looking at sectors, but also there will be firms that might not appear at the sectoral level being affected, but that will be particularly affected as well. So we need to go very micro and look at the actual impact.
And there's another side to this story, because as the United States erects trade barriers with the entire world, there's only really one market that can absorb that kind of capacity. That is the EU. How do you defend the EU market about all of this coming from China and the rest of the world, all of these products coming into Europe?
Of course, we're looking at trade diversion as well in order for us to be able to protect ourselves from this impact. And I think two elements here. One, we've done it already in terms of the steel market. We actually updated our safeguard clause to be able to protect and have our firms also act on a level playing field. But we will also have to engage with other strategic partners. And on that, going ahead with the Mercosur ratification, I think will be key also for some of these potentially affected sectors to gain new markets. For example, agriculture, the agricultural sector, and particularly the wine or the olive oil sector, which for Spain are also key.
And I'd like to just get your idea of how this changes the relationship and the conversation around China, the trade relationship. Your Prime Minister is heading to China very soon, and to Vietnam, two nations that notably were hit with the hardest levels of tariff. How does that change the relationship between the EU and China? Does this make China a more reliable partner? Does this increase the threat of Chinese goods to the European Union? How do you view that?
Well, we've been working on strengthening our relationship with one of our strategic partners, which is China, for the past few years already, with a strong diplomatic effort from the Spanish side. Actually, the Spanish president has been there for a few times. He's going there again this week, again, to strengthen those ties, to find new markets for EU products, and also to be able to attract Chinese investment, which will be another key element for our strategic autonomy going forward.
And so, but I just want to return to kind of the primary point here. Do you think that it is important to basically display the strength of the European Union in these discussions with Donald Trump? Because again, there is a sense that, yes, we can support industry to a certain degree, but this is a $1 trillion relationship that has been turned on its head. I'd like to get a clearer sense of kind of what measures outside of the sort of ordinary trade tools, tariffs, you're thinking about applying.
Well, the EU, again, I think we need to find the right balance in our response at this point. We need, again, to be cool-headed. But first is a message of course, lines are open. We want to negotiate. But in case we're not able to actually reach that point, we are ready to enter into using our instruments, which go, as you know, from the tariffs to a wider set of instruments that could also reach other elements, not only goods.
Well, thank you so much for your time. Carlos Cuervo, who is the Finance Minister, Economy Minister, Trade Minister, Business Minister of Spain, dealing with all of these issues that the Trump administration has put on the globe, really, for everybody, including the EU, and that will be discussed here among the trade ministers of the European Union. Kriti, send it back to you.
Absolutely. Bloomberg's Oliver Crook there speaking with the Spanish Finance Minister, Carlos Cuervo. It's crucial because he's having this conversation, Guy, as Pedro Sanchez not only meeting with some of his Asian counterparts as well, but also announcing 14 billion euros to mitigate the effect of tariffs. Deficits potentially back in the conversation. Spain
is dovish on this. The French are hawkish. Does the EU ultimately have to go with the most dovish elements at this stage and negotiate? I think that's going to be interesting. Barnabas Boage is going to join us from UBS next. Looking forward to that conversation. This is Bloomberg.
If you go back to Friday, the Fed can talk tough. They have to be looking at this. I don't know if they can even make it to the May meeting before they start bringing rates down. I think this is a serious moment. I do not think the Fed can just sit on the sideline.
What does Jay Powell do in this situation? Stuck between growth and inflation, stuck between a rock and a hard place. JP Morgan Investment Management CIO Bob Michael there speaking about that very dynamic. Let's see if Valerie Titel knows a little bit more on that subject. Val.
Kriti, if you look at what's going on in the Treasury market, we are seeing a big bull steepening of the curve. Those two-year yields down 17 basis points in the front end. The market is now pricing in the speculation the Fed will cut in May. And to echo Bob Michel there, talking about perhaps a chance of an emergency cut even before that meeting. This is a stark contrast to what we were pricing in Thursday and Friday of last week, where we thought we would see more of a Fed on hold for an extended period. The market is really starting to question that narrative today, but it has been a historic session, at least in the Asia trade. I just want to go over how bad it has been. The HSI, the Hang Seng Index, is closing near the lows. The HSCEI, those are the 8 shares that trade in Hong Kong, are now down 20% from peak. A lot of these Asian countries' business models, this export-driven business model, is really put into question with these Trump tariffs. We're seeing a widening of CDS spreads as well across the Asian sphere. So historic when it comes to the Asian route. It's also historic what happened in the last 2 sessions with the S&P 500. It goes on the board now with Black Monday in 1987, with the GFC, and with COVID in terms of the worst 2-day slide when it comes to the equity market. And Kriti and Guy, the worry is here. In these 3 situations, we had the fiscal floodgates and the monetary floodgates of easing open nearly immediately after. It seems right now we are a bit far away from that reality.
Val, thanks very much indeed. A note from UBS's chief economist in the United States, Jonathan Pringle, catching my eye. We expect US imports from the rest of the world to fall by more than 20%, he talks about, over the forecast horizon, mostly over the next several quarters, bringing imports as a share of GDP back to 86 levels, pre-86 levels. The forcefulness of the trade policy action implies substantial macroeconomic adjustments for a $30 trillion economy in 4 to 8 quarters. That is a big move that we are about to see for the US economy. The global economy is readjusting. Everybody seems to have been caught on the hop by this. Let's bring into the conversation the bank's chief strategist, Banu Buwaja. Good morning.
Good morning.
This is a huge adjustment. The market didn't see it coming. We're now starting to adjust quite quickly. How far through that adjustment process are we?
It depends on whether this is walked back or not, and it doesn't look like this is going to get walked back anytime soon, right? I mean, I think one of the fundamental or 2 fundamental beliefs that the market had was that this is a negotiating tool, tariffs are a negotiating tool, and that Donald Trump's administration, Donald Trump himself, is very sensitive to Wall Street, very sensitive to the S&P 500. Both of these notions are being challenged, right? So this
are they wrong?
I think they are wrong, because the way the administration has put it, first, if you think about the barriers themselves, if you think about the tariffs, how do you negotiate non-tariff barriers? Are you going to change, are trading partners going to change their entire tax system? Yeah. Are they going to change their entire regulatory setup? Are they going to change the way their currencies operate? So this is going to be hard to negotiate, right? But also, look at the number of people in the Rose Garden who were wearing hats and who were wearing high-visibility vests. And this says to you that they're really positioning this for the Main Street more than the Wall Street, right? So I think Trump's put, if ever there was one, the strike of that is much lower delta than the market had originally thought. So I don't think they're going to change their view anytime soon. Sure, reciprocal tariffs will come lower. We know that. Reciprocal tariffs over time will come lower. But first, countries will negotiate, right? And as countries negotiate, China is going quite hard. There is no sign of negotiation there. So there could be a spell of escalation before there is de-escalation. But also, there is the 10% universal tariff that is going to do damage. And I think it's hard to see how these tariffs come back to nothing anytime soon. And I think they also need these tariffs. They think they need these tariffs. They think they're going to get revenue from this to then go for the tax cuts. How much of that is realistic? Completely separate question. But that's the way they're thinking about it philosophically. And I don't think there's a lot of opposition. There's some opposition right now in the Senate. There doesn't seem to be a lot of opposition around that. So I think most people around Trump agree with these policies. So I think they're going to be walked back only slowly.
When it comes to his end goal here, which is, and he's made this quite clear, and that the U.S. is, or should be, a manufacturing hub is his big argument. When does labor start to become something that not only worries the administration, but is something that the markets trade off of?
See, I think the labor market is going to become weaker in the coming 3 or 4 months already. I mean, you're seeing leading it. See, here's the thing. Before we went into these tariffs, the U.S. economy was already slowing organically, because of the last 3 years. We've had this fiscal stimulus, we've had immigration. Both of these factors led to the U.S. economy basically being on steroids. And as the effect of those steroids waned, the economy was already slowing. If you look at Michigan, University of Michigan surveys for employment, you look at PMI surveys for employment, both of these were weakening considerably even before these tariffs. So some leading indicators were looking back. Now, this does look like it could lead to unemployment towards 5.5%, 5.3 to 5.5% by 2026. This is not going to be immediate because, again, early on in the year, there was a proper winter. Now we're coming out of that, so you could get a little bit of better activity. But come late Q2, Q3, you are going to see activity slow down significantly. That's going to have an impact on the labor market. Are we going to see sort of reshoring? Look, through Trump 1, if you look at U.S. industrial production, it's a straight line. So tariffs did not help reshore at that time. If you look at CapEx, there was no extraordinary growth. You cannot tell the tariffs had a major impact. Things have changed now. You know, Mexico, you may not get as much friendshoring as you probably get nearshoring, because in Trump 1, you got a lot of friendshoring in Mexico. Chinese companies opened up places in or factories within Mexico. That may change. But it remains to be seen how much you will get by way of nearshoring. The U.S. administration, you're absolutely right. This is their main objective, the main street. We're going to create a lot of manufacturing jobs. It looks like we're going to go the other way first, and the markets are going to trade off that because we have not priced this in. This is not priced into earnings even now.
So in the short term, then, is the trick to playing this from a market perspective simply the idea that you go and look at markets that are more domestically facing? For example, here in Europe, there's an argument that the periphery will continue to outperform because it has less international exposure. Is that how you think about allocation globally, where you choose, say, small caps over large caps, less international exposure? Is that the bet here?
So a few things. First, domestic over international, yes, because global trade was already weak, and this is going to sort of deal it a pretty strong blow from a bad time. Second, you've got to think about places that are much more interest rate sensitive, sectors that are more interest rate sensitive. So utilities, REITs, parts of housing are much more interest rate sensitive than our autos, than our materials, than are some bank stocks, for instance. So I think that is going to help. Those are places where you could see some safe haven in. But also other asset classes. Gold we have been enamored with for the last 3 or 4 years, and I think that's going to continue to do well because gold does react to real interest rates coming down. It has completely stopped reacting to real interest rates going higher since the Central Bank of Russia was sanctioned, but gold is still another place. And bond equity correlation is now negative. That is a big change compared to the last 3 years, and therefore bonds will continue to do well.
Big move this morning. It's just opening up now. We're down by 7 basis points, so we're getting another leg to that element of the story this morning. You can think about what is going on in the world right now. You can think about it kind of top-down, macro kind of. You can look at it that way. Do I need to get back into the place where I'm just looking at market internals? Is that where I'm getting to now, that I need to worry about what positioning looks like, what liquidity looks like? Are people being forced sellers? What's happening with margin calls? Are we getting back into that kind of a place right now with the kind of losses that we're seeing? You
always have to look at that, Guy. That's absolutely right. But there are a few indicators. You've got to be careful because there are a few indicators that might actually sort of wrong foot you. Because if you look at sentiment, for instance, historically been a very good indicator. If you look at the AAII sentiment index, for instance, bullish minus bearish, that's actually GFC-esque in terms of how bearish it has been, right? So really, really bearish. But then you look at positioning, and the positioning's really not come off, right? Not just not there yet. People have actually been buying the dip because that's their Pavlovian response. That was the right thing to do in 2020, 2021. Then there was a slowdown.
It's the wrong thing to do now?
It's the wrong thing to do now. I think it's hard to go and argue that you want to go in aggressively by this. I think you have to first wait to see how earnings adjust and what is the right level of earnings. For that, you have to solve for the right level of GDP. I don't think we're through that adjustment as yet. So
what else am I watching? The VIX, the big move in the VIX on Friday, up 50%. It's going to open at 8:15 this morning. What am I looking for? What am I watching for?
So the last shoe to drop, which has only now begun to move, is credit spreads.
Yep.
Yeah. They haven't moved as yet, so they have only now begun to move. And so valuations in equity, I think many equity investors miss a trick in not looking at credit. When high yield spreads stabilize is when U.S. equity valuations stabilize. When equity valuations stabilize is when the market stabilizes, not when earnings stabilize. So earnings bottom much later than equity valuations.
It's all about credit spreads now.
I think right now this is going to be about credit spreads because this is not just sort of the first order hit because of tariffs, growth and inflation. This is now going to hit the overall economy as well through a slowdown, through confidence, through capex being weak, through consumer sentiment and consumer confidence and consumer spending being weak. And that is going to lead to potential for higher defaults in companies that slowly are actually seeing their interest costs going higher over the last few years. So I think high credit spreads are likely to widen out. And every 100 basis points widening of credit spreads, we think, is about 1.5 times lower in the forward PE multiple of the S&P, right? So we do think there's further widening of credit spread here. Now, credit spreads are going to widen, not quite as much as they used to at the time of balance sheet crisis. That's certainly not the case right now. We're not in a balance sheet crisis. This is an income statement problem, and you have the private credit market, and the quality of credit is improved. All that's absolutely true. But credit spreads should widen from here, and that means derating of the S&P should continue here.
I want to bring it back to the equity market here, because the credit spreads, it feels like, are ultimately kind of responding to maybe the carnage you're seeing partially in the equity market as well. You mentioned the earnings clarity we don't actually have. Dan Ives over at Wedbush, the major tech Uber bull of Wall Street, is expecting a 10% earnings cut even if we get this resolved in a month. He's still saying that uncertainty takes that kind of hit. What kind of earnings hit can we expect just from the uncertainty itself?
Every 1 percentage point hit to real GDP historically has been about 6.9% earnings hit. All right. So we think you could, and actually, and this goes back to Jonathan Pingle's point, guy, that he was speaking about earlier, that, you know, we're going to see a big GDP hit. Actually, GDP may be the wrong lens to look at, because your GDP hit could be sort of ameliorated by the fact that your imports collapse, X minus M, and if your imports come down, then your GDP doesn't get hit. Your C plus I plus G, so your domestic demand, could be hit much more. And as that happens, Kriti, so you get about a 1.5% drop in domestic demand, that could easily lead to about a 12-13% hit in earnings. But for that, I would argue tariffs would need to stick around for a while. I don't think, I mean, although I am quite concerned, I have been for a while, I don't think a 1-month tariff hit is going to lead to a 10% earnings downgrade. For that, you need them to be around for a while, but it is realistic. It's plausible.
Where are the cracks that you worry could widen here? What are you seeing in private credit? What's happening in the private markets? Where else are you potentially looking for that kind of second derivative effect that starts to accelerate and becomes more problematic?
So I'm looking first in U.S. credit markets.
Yeah.
That's absolutely right.
Public and private.
Public and private. Usually, if private is going to lead public, so it's going to come from private credit markets, levered loans, then high yield spreads, and then it's going to sort of broaden out to the overall market. If things are going to get bad, then that's one area to really focus on. The other area to focus on is how China goes, because so far the market has not taken China's equities down in a very big way, right? But this is effectively a 64% tariff on China at a time when structurally Chinese growth has been weakening. We've been bullish on Chinese equities for a very long period of time. We've got to sit and reassess whether that's still the right call. So if China slows down further, all the stimulus is not enough. What impact does it then have on the rest of the world? This is not just a U.S. problem. Everybody has been looking for safe harbor in Europe. Everybody's been looking for a safe harbor in other markets. But China has been cooling for a while, and that's a structural slowdown. Add to that a cyclical slowdown. That could be a little more problematic as well. So I don't think we can sort of rest easy thinking this is a U.S. problem and let's all go buy European banks. It's harder than that.
Well, the China infrastructure piece was a big savior, or I should say help, after 08 and in the 09 recovery. Banu Baweja, Chief Strategist over at UBS Investment Bank, we thank you so much. More on the markets to come. Stick with us. This is Bloomberg.
Twelve minutes ago, till the market opened this morning, it's going to look ugly. It is pretty ugly right now. Potentially it could get uglier from there. A lot of moving parts today that we still don't understand what the outcome is likely to be. Keep an eye on what's happening with this EU meeting that could potentially deliver the response that we've been waiting to see. How does Europe come out, I think, is going to be fascinating. You got some meetings at the White House a little bit later on. Silvio Adania, Chief European Economist at Barclays, sitting around the table with us now. We're just talking to Banu about kind of what he is watching right now. What are you watching right now to give us a sense of where we are in this process?
Well, we are obviously watching what the policymakers will decide today. It's quite important. We don't expect a big retaliation from the European Union, and that is going to limit the fallout and makes the ECB job easier.
Okay.
Because at least it's not going to bring in an inflationary shock in the euro area.
Yet, we don't get a European response yet. Does that ultimately come? The indications are that the White House is not for turning right now. If the Europeans can't negotiate a better deal, do we get a bigger response?
We definitely think that we are going to have an increase in tariffs or some response that could hit digital services, the big tech company of the US via antitrust law. But specifically in terms of tariffs, we are now working under the assumption that tariffs will be lifted to something like 5% from goods that Europe import from the US.
Sylvia, what is the reaction function in Europe from the United States in terms of growth? So if the United States does go into recession, how quickly does Europe follow?
Well, we also have a recession in the euro area by now. Obviously, Europe was also starting from a weaker economic positions. The way we think about this is tariffs obviously slow down trade, and Europe is quite open. The US is a big trading partner, so exports will go down. But also importantly, as you all know, trade policy uncertainty has gone through the roof. We have a shock that is something like 8 standard deviations, and so this is going to have a negative impact on domestic demand. We think businesses are going to remain on the sideline, and so investment, but also consumption, consumer households are becoming worried about losing their jobs, and their saving intentions is at all-time highs. And that is going to have an impact on consumption growth and domestic demand. So we are expecting 3 consecutive quarters of negative growth in the euro area, starting from Q2.
You're already starting to see world leaders. We just had Carlos Cuerpo over on from Spain join on the program, and Pedro Sanchez talking about a 14 kind of billion euro kind of influx of cash into the economy. Is that enough? And if these European economies start to put this cash into the system to prepare for the outcomes that you're talking about, when does deficits start becoming a concern?
Look, we also think that the European leaders are going to provide some support to sectors that are going to be hit the most by tariffs. Now, most likely, we think some furlough schemes will be back in place to try to mitigate the impact on unemployment. But as you say, the fiscal space in some European countries is definitely much less than what there was before COVID. So deficits are going to increase, but not to the same extent that we have seen, we think, in the past. The decline in interest rates and more monetary easing is going to help, cushioning the impact on deficit via interest rate expenses, in our view.
German yields are down sharply this morning. Italian yields are higher this morning. Is that a trend I can expect to continue?
Well, definitely, we expect that core yields are going to, benefit from more expectations also of more monetary easing and then recession calls. In terms of fragmentation, again, we know that the ECB has specific tools in places, so there is a limit. I think there is a backstop in that respect to how much we think spreads can widen.
If I'm feeling really positive this Monday morning, I think Europe loves a crisis. Okay, so this is going to be the moment that Europe finally decides to do Draghi, and we get banking union, we get capital markets union, whatever we're calling that now. All of these things, these good things that we've been waiting for, happen. Do you think that's? Am I being overly optimistic?
Look, I think if in terms of the big message, I would share with you that crisis always help to make the next steps in terms of European integration. Now, we know that the process is complicated and it takes time. So we will make a further step forward. We have seen it already with the defense spending, and more discussions are ongoing about, doing something on defense at the euro area level. There might be some other facility to cushion the impact on unemployment. But again, we are not going to have a political union or a fiscal union in 6 months. Let's be realistic.
No.
Well, Sylvia, we've been debating this morning about what Jay Powell can even do. He kind of stuck in a rock and a hard place from a stimulus perspective. China, on the other hand, already looking to unleash stimulus and support and stabilize. If we don't get some sort of fiscal support from the U.S. that bleeds into Europe, could fiscal support from China bleed into Europe?
Look, China has become quite a competitor of Europe, so we worried about the fact that China can actually, sell at reduced prices the overcapacity that they would have because of tariffs from the US, and that could be a disinflationary shock for Europe rather than a source of higher demand for European exports. In terms of, the response from the US, again, we expect that the Fed will cut twice interest rates, one in June, one in September, but then that the Fed will remain on hold for a year because obviously the trade-offs is very complicated there between, weakness in economic activity but high inflation. We have revised our inflation forecast to, 4.1% in the fourth quarter of this year on a core CPI basis and 3.7 on core PC.
It's certainly some scary times at the moment to be. I feel like forecasting. I don't envy your position. Sylvia Ardagna, leave the conversation there. Chief European economist over at Barclays. Guy, she's talking then about just kind of not really knowing where that next leg of growth really comes from.
I think there's so many imponderables at the moment. Yeah. It's really hard to look at the data and read anything real into it because the situation is changing so quickly right now in the here and now. There's such a lag. Do I believe the data right now? I don't know. What's the Fed looking at? What is the central? What is the ECB looking at in terms of the data that it's watching carefully at the moment? I don't envy any economist. Do I want to listen to the economists right now? I don't know. That's a tricky question, considering they're all trying to understand what is going on in real time.
Well, so much of it is dependent on that policy that we just don't know. And I'm sure folks in the White House actually know. In the terms of futures, this is really something to see. You're looking at Euro Stoxx 50 futures down a whopping 6% and counting. It's even worse in France and Germany. Coming up, it's the opening trade. This is Bloomberg.
Monday the 7th, good morning. I want to start with a S&P futures two-day chart, just to give you a kind of sense of the context of what we're looking at here. That's the gap first thing this morning that we've been through. So we come in Monday morning, gap lower, trade sideways. On a two-day basis, we're now down by 10.4%. You can see the drop. Obviously, Friday, we get this kind of accelerating move towards into the close. That then gaps lower, we trade sideways. Waiting for a little clarity on what is going to happen with European futures. Very negative there at the moment. Do we see some sort of stabilisation after the open, or does the situation accelerate? At the moment, it looks like European futures are going to be heading lower. The cash open is going to be pointing us to a negative story as well. That's what the future picture looks like at the moment. Euro Stoxx 50 futures are down by 3.4%. Kriti, what are we looking at elsewhere in terms of the single stocks story? It feels like a top-down market, but single stocks matter.
It is very much a top-down market, but of course it's varying degrees of where that pain is going to be felt that you've been pointing to. I'm just going to go sector by sector here. Bank stocks, of course, very much in focus. If you are worried about the rates picture changing on either side of the Atlantic, this is where it's going to be hit. But what's great about European banks is they all have different exposures internationally. So I'm going to keep an eye on which ones outperform and which ones underperform. Their defense stocks have been the haven in Europe for quite some time as well. This idea that the fiscal stimulus and the fiscal impulse coming out of Germany is going to keep that part of this market perhaps untouched. Is that true today, where so much of that accessibility to U.S. defense manufacturers may be in question? Of course, mining stocks very much in focus, Guy. Of course, we have one eye on what's going on in China. They're talking about perhaps stabilizing the market via the currency, et cetera. That might be reflected in the mining stocks this morning.
Okay, Kriti, that wraps things up. Let's get into the opening trade. We are waiting for Monday's trade. How ugly is it going to be? Let's take a look. We're expecting some ugly numbers to be posted. Right, here's your opening trade. Let's dig into what we are seeing right now. FTSE 100 expected to do better this morning, but it's already down by 0.2%. It's expected to open. It's expected to stabilise significantly lower than this, say maybe down by 0.3%. 600's out of the gate, down by 0.6%. You could see this much worse. You could see kind of 4% down. So FTSE down maybe 3%, Stoxx 600 down potentially 4%. We need other markets to open. This could be a very slow market to open this morning across Europe. We are expecting big losses in big markets like the DAX. The IBEX, Kriti mentioning what's happening in the Spanish banks. That sector, that market is already down by 3%. We'll see whether that accelerates to the downside. The FTSE is now down by 2.2%, 2.3%. We're expecting the CAC to open sharply to the downside this morning. The DAX will be the big one, wait and see exactly how German stocks are being affected. You've already seen a big move in bunts this morning where we are catching a bid. That tells you about maybe where the flows are moving as well. So that is the picture thus far. I think it's going to be a fairly torturous process maybe to open these markets here in Europe this morning. Bid-ask obviously coming together quite slowly as we await some single stocks that are quite hard to price, Kriti. So what are you seeing in terms of the sector story?
Well, Guy, the market is open. At least the Stoxx 600 is open, and not one stock is in the green. I'm seeing a series of flat. I'm seeing a series of unchanged. We're seeing a lot of liquidity come through this market as well, but all to the downside. You can see it on your screen there. Still, the market trying to digest what you're trying to actually see. When you look at the downside, though, some of your index contributors to the downside right off the bat are a lot of the biotech names and a lot of what are in your kind of core six as well. Plenty of volatility halts showing up in this market from the banks, SocGen, Deutsche Bank, for example, among many, many others. So again, I think this takeaway this morning, while we're waiting for this to all shake out, is simply that the markets don't know what to do. There's a plumbing question here as well, and that's what we're trying to navigate right now.
I think the markets do know what to do. You sell. That seems to be the narrative this morning. But as you say, in terms of where the losses are coming through, it's fascinating. So the biggest points drop this morning, and much of this market is still not open, is Nestle, which is fascinating. Yeah. In some ways, that should be the safe haven in this trade. But it's the fact that Nestle is getting hit as hard as it is this morning. Nestle's down by nearly, well, it's 3.5% to the downside. That should be the area you run to and hide in.
Yeah.
Nestle is dropping sharply, but now we start to get some of the bigger names coming through. SAP is down by 6.7%. You've got LVMH down by nearly 7% this morning. As you say, some of the farmers are down really hard. But the fact that Nestle is doing as badly as it is tells you a lot about market sentiment.
It tells you a lot about market sentiment. It also tells you about the underlying dynamics of this market, which is that there are a lot of firms out there dealing with margin calls right now. And what happens with margin calls is you sell your most profitable trades. And even though in the States, a lot of that has been the Mag 7, and it's been the outperformers there. Here in Europe, that defensive trade hasn't just been defense stocks. It's been, to your point, consumer staples like Nestle. So it's unsurprising that that's perhaps the first place where you would want to unwind and take some profit.
Allianz is down. SAP's down hard. Rheinmetall. Just need to check my numbers here. Rheinmetall is telling me it's down by 27%. Okay? That is a stock that's had a massive bid attached to it. I just want to check exactly what's going on there and make sure I'm not looking at something odd and erroneous. But Rheinmetall is down 27% on my board at the moment. That has been a stock that has run up hugely. If you're talking about forced selling, maybe that is an area that maybe that is coming through this morning. So you've got Novo Nordisk down by 7%. That stock's been under significant pressure for quite some time. The DAX is down 9%, folks, this morning, as some of the big names that we've been watching very carefully of late come under significant pressure. So Rheinmetall, that stock has been on a huge run. It's got a volatility interruption right now. I want to check the GP in terms of what is happening here, just to get a sense of that drop. This was a stock that hit the high of 14.45. It is now this morning trading at 9.33 on the board that I have in front of me, but it's not trading. There is a volatility interruption on that stock.
Volatility halts across the board. What does that tell you here? Where the markets are still digesting, there is no, it feels like there's no buy the dip sentiment anywhere where you look. But that DAX move down a whopping 9%. I'll match that up with CAC, for example, down 4%. We're looking at some of the other indexes around Europe, circa 7 to 8% as well. I think now is the perfect time to bring in a markets guest. You can perhaps navigate this a little bit. Poor Ben Guttridge, portfolio manager at Invesco. We put him in the hot seat. Is that what this is? It's just sell, sell, sell until when?
Well, just sort of trying to deal with my nausea after your sort of open there. It's a really, it goes without saying, it's a really troubling and difficult period for investors, and a catalyst that might invoke some sort of turnaround you would think would come from policymakers. You know, it doesn't seem as though, I mean, that seems quite a distance from certainly the US administration and the Fed policy. Again, got their hands tied with the inflationary challenges as well, which doesn't seem there's an emergency cut coming from there. So, look, it is hard to say with any conviction that we're going to get, like, a reversal in stock markets at this moment. Recessionary risks on the rise. But, look, there are, as you know, as the world grapples with US trade policy, but there are reasons to believe that, you know, a bottoming may not be a million miles away, why there might be some good days in amongst some bad, and that sort of centres on the hard data.
What causes the bottoming? What causes the market to stabilise?
Well, I mean, it's the hard data, the survey data, the guidance from businesses and consumer sentiment, you know, is challenged. It's the hard data.
We saw hard data on Friday, the payroll number. It was really strong. The market continued to sell off.
Yeah. Well, I mean, it is, at the moment, all eyes are on, trade policy and how this is going to impact growth. And there is a very difficult analysis there because the duration of the trade spat, the degree to which things may be resolved, these things are very difficult to forecast. And therefore, you're seeing this sort of bloodbath in markets at the moment. But, if you get decent earnings performance and, the economic data, the hard data, can continue to stay resilient, then that could feed into some dip buying. Obviously, we've had a material valuation adjustment as well, which could attract investors. But I'm not saying this is a fantastic opportunity. I'm just sort of alerting that there could be some good days in amongst the bad here. But certainly investors should brace themselves for continued volatility and challenge from stock market performance.
You use that keyword valuation. I think it's really fascinating because in 2020, in March of or February of 2020, when that COVID-driven sell-off started, the conversation in January of 2020 was that the market is overvalued. This market is going way too hot for a very long time, and that even though COVID was, of course, a global risk, you were combined with that idea that the market was already overinflated. And I'm kind of having a little bit of deja vu now, and that, yes, we're talking about recessionary risk. Yes, we're talking about this massive kind of shock to the system, but we're entering it at a time when the market was already thought of as overvalued. So I guess I should say, what is fair value right now for this equity market?
Well, yeah, there is certainly the valuation risk was more material coming into this sell-off. We've seen some adjustment in that and could well see some more. But things that might offer some positive adjustments to the fair value is that we're not sort of seeing sort of level of private sector imbalances either. I wonder whether you think I'm clutching at straws here, trying to extract some positives. But the jobs market is in reasonable shape at the moment. Consumer balance sheets are in good shape, and the relationship, as the Fed chair has articulated, between survey data and sentiment data versus transactional data isn't perfect. If people need something, they can afford it at the moment, and the jobs market, perhaps that confidence is ebbing, but at the moment, not compelled them to save dramatically more. So, look, I think with the private sector and consumers still in reasonable shape, that could offer some positive adjustment to fair value.
Well, speaking of positive adjustments, Ben, we are looking at a market that is still shaking out. We are looking at volatility halts, specifically around the banking sector. Our correspondent Valerie Titel telling me here that 19 out of the 28 banks in the banking sector or in the banking index are still halted. And as they come out of the halts, there are some massive declines here. We're getting banking earnings in the States on Friday from likes of JP Morgan, et cetera. Do things like extra loan loss provisions, extra liquidity, stopping acquisitions, stopping buybacks, those kind of messaging from a lot of these corporates issue confidence in this market, or do the opposite?
Well, I mean, if you get that collection of things, you would think that should offer some confidence, But, market's looking at a lot of things at the moment and eyes more squarely, I guess, focused on trade policy. But that's that type of data that could offer some support, and I guess given the dramatics, but it's how much credibility the market extends it, because things have happened a lot in the last, the world seems to have changed quite a lot in the last sort of week or so, and how much that is reflected into, banking provisions, how much loan loss provisions would they release into the market? Perhaps they might you'd think they might want to be a bit more cautious about that, given what we've seen in the past few days. So the market might not extend quite so much credibility, but, a decent earnings season, I think, is going to be helpful. It's just how helpful.
Do you stay invested?
Yes, he says. What do you think about the hesitation in the delivery there? Is that a bit of a read? No, I think it depends on time horizons. We have an 18-month, 2-year time horizon for most of our portfolios. So, I think that a lot of pain has been taken, and I think there is scope to stay invested here. But the marginal moves, should be, I guess, getting longer bonds into portfolios, longer-dated bonds into portfolios.
Cash?
No, I don't. I think longer-dated bonds would be a better hedge against equities, recessionary risks than cash at the moment. I don't think the inflationary challenges are so daunting that cash is the right answer.
Longer dated bonds, that's a very kind of bearish recessionary call. What kind of timeline are you looking at for that to pay off?
Well, I'm hoping it doesn't pay off on the basis that, you know, we avoid recession and therefore long-dated bonds...
But if we were to get a recession, when would it show up?
Well, I guess you sort of... I mean, it could begin in Q3. It could start in May, I guess, is the like recessionary... You know, that is when a recession could I guess begin, but more like Q3, Q4... Yep. As the recessionary call. But you want to move in advance of that, you know, so longer-dated bonds look like and remain the best hedge against an equity market position and a hedge against recessionary outcomes.
Ben, when you talk to your peers, when you're sitting around the table at the moment, what are you guys talking about? What are you watching for? Which areas of the market are you looking at? Are there any signals that you're concerned about? Is there a liquidity story here that I need to be concerned about? Just give us a sense of... You can. I talked about this with Bono earlier. There's a macro story. There's a top-down kind of what the heck is going on, what's going on with the truck. But there's now a market internal story, which takes on a life of its own sometimes. And I'm wondering whether we're at that point yet, and it feels like we are. But what you're watching within that, is it the VIX? Is it what is going on within the market that you're keeping an eye on?
Well, I mean, it's from the top down, it's labour market data that would give us the greatest anxiety about recessionary risks. As we saw, the jobs numbers was actually relatively
but within the market.
But within the market, well, I guess to round out the macro data, you look at things like challenger numbers to look for material weakness in labour market. But within the market, we're talking about US exceptionalism and the threat that's presented there, and the idea that these events, US trade policy and international policy, may be bringing Europe closer together, and that cohesion could be a nice story, tailwind for European equities.
Ben, great to see you. Thanks very much indeed for stopping by on what is a tough morning, I suspect. Ben Gutteridge, Portfolio Manager at Invesco, thank you very much. The VIX is about to open. It should be opening in the next couple of minutes, so we'll get a read on where we were. Remember, it was up plus 50% on Friday. Core 6 looks like this. Let's take a look at the centre of gravity here in Europe. You've still got a bunch of stocks that are not open right now in terms of the Stoxx 600. So getting a read on what is happening here, I think, is really, really difficult. So you've still got an awful lot. Let me just get you a number here. So unchanged, we've got 51 at the moment. Down, you've got 550. Kriti, it's not a single stock in positive territory. Not a single stock is up in Europe this morning.
Despite several gaps lower across major benchmarks, across the S&P 500, when we've seen this in previous iterations, we've seen buy the dip. And there is no evidence of that this morning.
Absolutely. Let's talk about where we're seeing really some of the biggest action this morning. Defence stocks, some of the pharma names. Joe's here with the details.
So we are seeing some absolutely sensational moves in the defence stocks this morning. Guy, take a look at Rheinmetall. We're down 18% on that stock at the moment. It was down around 27% at the open, coming up very slightly. ThyssenKrupp, Leonardo, Airbus, all of those in double-digit losses. Leonardo just gone into a trading halt. Now, traders telling me in my IBs that people are cashing in, trying to make up these margin calls very quickly this morning. And also there's that report out of the US that Howmet over in the States potentially declaring a force majeure on some of its supplies, and therefore that is reading through into Europe today. And also the bank stocks, I had my eye in particular on Stanchart, because we were down 17% over in Hong Kong. We're seeing losses of around 8% for Stanchart at the moment. Not quite as big. Potentially there was some catch-up from Friday, but also UniCredit just going into a trading halt as well. So much volatility in these markets at the moment. Barclays down another 8%. Bear in mind that that index was down 10% on Friday as well. And another sector hit hard is the miners. We saw weakness across commodities overnight. Copper was down around 3% on the US trading, and also iron ore was weaker. Oil, of course, coming down as well. So therefore, we're seeing these London-listed miners hit once again. Losses around 5% across that sector. And even Anto down around 6% at the moment. Big declines for that sector. And then staying in the commodity space, we have got a bit of an update from Shell. A huge move lower in that stock. They do have a trading update saying that they are potentially going to be producing less gas than expected, but this really seems to be a broader market move with the oil price decline really hitting that, but probably not helping on that trading update from Shell. And then finally, to finish back on Novo Nordisk, news over the weekend that the US potentially rolling back Medicare support for obesity drugs. That was announced under President Biden. Does seem to be an extra weight, but again, everything selling off. Defence, healthcare, all of the sectors in the red today. Novo Nordisk, though, one of the big decliners by a points basis in Copenhagen.
All right, Joe Easton from our equities team walking us through some of the carnage that we are seeing in this market. As he was chatting, I was just keeping my eye on this bond market. Guy, massive moves across every region, across every curve. To me, what's standing out some of the spreads here. The Bund spread back to 83. We were at 75 on Friday. Same gigantic, about 11 basis point move when it comes to BTPs versus Bunds as well.
Stoxx 600. So Stoxx 600 peaks in 99 at 400. 2007, it peaks at 400. We're now trading at 466. We've come down really, obviously, quite sharply off a peak was kind of in the mid 500s, 530, somewhere around there. Yeah. 400 is going to be a really interesting line. If we get anywhere near that, which is obviously a long way from where we are now, but the current trajectory, the rate of change at the moment is very, very ugly. Kind of where does this market find support? Where does this market find some sort of respite from the selling that we are seeing right now, which is aggressive? Volumes obviously are picking up quite sharply. This is a market that is selling and selling hard and is going to ask questions later. When do the questions start to get answers? I don't know at the moment, but there's some really interesting levels out there at the moment that could be watched very, very carefully. But at the moment, it feels like indiscriminate selling. Well, maybe not indiscriminate selling. People are selling defence stocks. The areas you've seen gains in are what is being hammered this morning. That tells you a lot about what's going on below the surface.
Absolutely. And, of course, we are still, I think the S&P 500 closed at minus 17% as of Friday. We are looking at bear market territory. Futures are trading at 48.79 approximately over in the States. The bear market level, I'm told, is 49.15. So futures already expecting us to breach that level when it comes to the U.S. Open in just a few hours. It is grim out there, folks. Selling across the board. Stick with us. We're going to have you covered. This is Bloomberg.
21 minutes into the session, and folks, it is very, very, very ugly out there this morning. We are seeing a huge risk-off move, and it is being reflected in stocks. It is ripping through other asset classes. Europe is down hard, as you can see. Remember, this follows on from the big losses that we saw at the back end of last week, Thursday, Friday. You are seeing it ripping into other markets as well. The VIX has just opened. It is up 29%, 30% this morning. We are now trading with a near 60 handle. In fact, a moment ago, we did have a 60 handle on the VIX. We are trading at 58.85. That's an indication maybe of the fear that is out there this morning. You are seeing European banks under pressure. You are seeing people selling what has done well, very well recently. The defence sector is being absolutely decimated this morning with some huge, huge losses, Kriti. Look at names like Rheinmetall. When it opened up this morning, it was down like a quarter. We're coming off those levels, but it is still an ugly move in that space. It is still an ugly move and still no sign of respite. Let's go to the oil space as well. We are seeing quite a bit of movement as well. We are now seeing NYMEX trade below $60 a barrel. Brent still at a 63 handle, down a whopping 4% on both levels. Let's bring in an expert here. Bloomberg Energy reporter Stephen Stepchinsky joins us this morning. Stephen, this oil market responding very much to the growth scare. How low can it go?
Well, according to Goldman, it will go to about 62 Brent by December. But they've reduced their outlook 2 times in the last week. So maybe they're in for a hat trick. Who knows? I think what we really need to focus on is actually, you know, what happens in terms of demand, in terms of consumption, in terms of recession. I mean, this is clearly just following the overall sell-off in the market, this risk-off appetite. So when will we see the bottom? It's not 100% clear, but I think we might get to a point where, if you're talking about fundamentals, shale drillers are going to have to start pulling back rigs. So if we're getting to that point, which won't be anytime soon, it could take weeks or months for them to reduce their output. When you start to see that, I think that's when you're going to begin to see a recovery in oil prices.
Separate out for me Trump and OPEC. What effect are they both having?
I mean, it's supply and demand. So Trump is potentially the demand side. His tariffs and the retaliation from China are threatening the global economy. That could reduce energy demand, and that reduces consumption of everything from oil, gasoline, and other products for the fuel. At the same time, OPEC Plus is adding supply to the market, which is sort of flooding this already weak sort of situation, adding to the bearish element.
Stephen, great to catch up. Thank you very much indeed. Let's bring in Valerie to get a conversation on around what is happening in the other asset classes. Banks are being hammered. European banks are being hit really hard.
Yeah, if we look at some of the banks at the bottom of the basket, I mean, Commerce Bank down nearly 10%, SocGen down 8.5%, Deutsche Bank down 7%, and this is just compounding losses from Friday. The SX7E over the last 3 sessions is now down 20%, and we're seeing this happen in tandem with credit spreads moving wider. I'm looking at high-yield spreads gapped wider on the open. This is a very nasty session when it comes to credit risk. We're even seeing that dynamic happen in the government bond space. We're seeing a big rally in Germany, but what's left behind? Italy, Spain, Greece. This is a credit widening event, and this is not a good time to take any risks here in Europe.
So I mean, obviously every market is panicking here. Every single one. Why is euro dollar up at 110 right now? And how sustainable is that?
Yeah, good question. I mean, FX has been kind of the market that's been confounding people of late. We haven't activated that left-hand side of the dollar smile, seeing a big move into the dollar on risk off. We haven't seen that. We're not seeing that today. The Bloomberg Dollar Index is down 0.25%. So that's a big question over, is FX really the barometer for markets here? I don't really see that yet. Where I'm looking at is developed market credit spreads, because we saw the widening in Asia as well. Look at some of the CDSs on some of these Asian nations. Their economic model is put into huge question, and I think people are starting to bridge that with Europe as well.
Defense stocks are being sold hard. What does that tell me about people's portfolios right now?
In a lot of pain. But to be honest, I don't think defense stocks is what I'm watching as the barometer. Those are stocks that have outperformed so far this year. But I'm looking for where in the market are we pricing?
But is there forced selling going on?
Yes, perhaps. If you look at what's going on with gold, it's kind of telling that as well. We're down another 0.5% in gold, and that happened last week because that's where people have been selling in order to access some liquidity. If you're down a lot on positions, you're getting margin calls. You have to hit your winners, and that's what we're seeing today.
You're seeing that on the tech space as well. And we should mention that, again, back in the futures picture in the U.S., down whopping 5% almost, as is where we're at. Bloomberg's Valerie Titel walking us through some of these markets as well. The response function, guys, is going to be crucial here because we are still looking at a bond market that's continuing to tank. 390 on the yield. I say rally. The yields are continuing to tank. 390 on the U.S. 10-year.
The assumption has to be that Europe is not going to respond aggressively at the moment. That's the language that we're getting. Yet European stocks, risk assets are being sold and sold hard. What will this look like if Europe does respond?
Yeah. Is this the catch-up trade to Friday, or is this the setup to today? That's the question for a lot of these equity investors. Coming up, we're going to talk about that European response as EU trade ministers meet in Luxembourg. That conversation next. This is Bloomberg.
With 30 minutes into the trade, I think we're going to call it Ugly Monday at this point. There may be other, maybe more colour-related adjectives describing this very, very shortly. The Stoxx 600 is down by 6% this morning. You've got the DAX in Germany down by 7%. The CAC is down by nearly 6%. The FTSE 100 feels like a relative laggard in terms of the selling that we're seeing this morning, down by a mere 5.2%. The selling is ugly. It is across the board. We are seeing certain key sectors firmly in focus. People are clearly having to sell what has done well recently. You can see that very much in the defence sector. You are seeing some big names being posting some very big losses this morning. Rheinmetall is down by 13% now. It opened up much worse than that. We are seeing a bid maybe coming back in a little bit, but it's still down heavily on that trade. ThyssenKrupp is down by 12%. Leonardo still is not open yet, folks. We have not opened Leonardo this morning. Or we don't have it open right now. Airbus is down by 10%, circa 10%. As we were hearing a little bit earlier, a supplier part of the supply chain for the aerospace sector has called force majeure. That is going to have a big ripple effect throughout the entire space, so keep an eye on what is happening there. So that's what you are being forced to sell this morning. Let's take a look at the banking sector, because this is the epicenter of the story, as Val's been pointing out this morning. It is the relationship between credit spreads and the banking sector that is worth watching. Standard Chartered, HSBC, Barclays, UniCredit, some of the biggest names in Europe are down 7%, 5.5%, 9%. Barclays is down 9% this morning. UniCredit is even worse. It is down by nearly 10% this morning. It is down by 9.7%. There are some big, ugly losses in a number of key sectors, and we are watching them all very, very carefully. You want to know what's happening in terms of the risk gauges? Let me show you what is happening with VIX. Remember, a 50% move Friday. This morning, we get a huge move as well. We spike higher. We are north of 60 right now. We're not north of 60. We're at 59.18. We're just below 60. We got north of 60 on the VIX, a big leg higher in terms of this market metric this morning, which is also worth keeping an eye on. You don't see these kinds of levels very often, Kriti.
You definitely don't see these kind of levels. Let's talk about where the money is flowing to, where the fund flows are flowing to. And a lot of that is going straight into the bond market. Take a look at these massive moves you are seeing on both sides of the Atlantic. I'm going to start bottom up here. The 10-year is now seeing a 10 basis point move over in the States, 389. We are sub below 4% and by quite a bit of a margin. A bigger move over in Germany, 12 basis point move lower. Now, this is crucial here because you are seeing a bid across the curve, across regions, into a bond market that still has to digest the inflationary impulse that these tariffs may be bringing on both sides of the Atlantic and even across the Pacific as well, which brings me to a chart that caught my eye. I want to bring it right back to the equity market because as you see this move lower in yields, in theory, financing conditions should be easier, and yet the uncertainty stops that, which brings us back to the first time in about 2-3 years that we are seeing over 15% drawdown in the S&P 500. That is what we are counting down to the U.S. Open in just a couple of hours. Even though we are 30 minutes into Europe, you are seeing the bloodbath. It looks a lot like the bloodbath we've seen only 3 times since the COVID crash. Let me walk you through. I'm going to take a time back into history here where we go back to 2020, March of 2020, the COVID crash, that massive drop. It took about only 5 months to rebound. So if you're asking how long the sell-off is going to last, if that is your indication, only 5 months. I'm going to speed it up here to 2022, where, of course, you saw that major bear market, the one year that you in last, I would say, 10 or 12, where you start to see major losses in the S&P 500, a rebound that only took about a year and counting. So a very fast compared to historical norms, which brings us to here. Check out this chart here. You are seeing, you really have to zoom in, but gaps lower. We are now 17% of a decline guy when it comes to the S&P 500. Now, these two previous instances of this over 15% drawdown had a rates picture to look at. Dovishness from the Fed in March 2020, hawkishness in 2022. Perhaps that's the policy uncertainty the markets are going to be looking at next.
Absolutely. Let's talk more in detail about policy uncertainty. Are the leaders gathering in Luxembourg today from the EU going to be paying attention to what is happening with these markets? What are the markets signaling about expectations in terms of what the European response is going to be? The mood music, certainly at this point, appears to be broadly that actually Europe wants to talk rather than deliver a big hit in response. But is that going to change? How will that be altered by maybe what we're seeing in the markets today? Let's go to Luxembourg ahead of that meeting. We've already had a conversation with the Spanish to get their take. Ollie Crook taking part in that conversation. He joins us now. Ollie, set the scene for us. How does Europe respond?
Yeah, Guy, well, the backdrop behind this scene is, as you're saying, basically a bloodbath in the market this morning right across the screen. And what we are anticipating here from trade ministers is against that backdrop, against the kind of selling we've seen over the last couple of days. And really the total uncertainty for the months to come is what is the European collective approach going to be to the Trump administration in dealing with this? I think we can call it a trade war at this point. There are different views. We've heard from Emmanuel Macron. He's been very explicit. He's been urging European companies not to invest in the United States, to basically put all of those investments on pause, exact opposite of what Donald Trump wants to happen, basically saying that that would be sending a wrong signal. The Germans have also been very outspoken. Remember, the Germans are the second most exposed to the EU in terms of their trade deficit with the United States. Robert Habeck basically likening this tariff increase to the invasion of Ukraine, saying that the Europeans need to be as powerful in their response to that as they were to the tariff situation. We've heard, though, also from the Spanish. We heard just now from the Spanish economy and trade minister taking a slightly more diplomatic approach. That being said, he also said that everything's got to be on the table. Have a listen to what Carlos Cuerpo told us just a few minutes ago.
we have to somehow avoid taking out of the table any instrument. We have the proper tools, the necessary tools to respond. So none of them should be discarded at this point, but we need to keep on sending a message of being open to negotiating with the US, but we need them also to be able to negotiate. We need two to tango.
It's very clear that the Europeans' preferred option would be to have a deal. But listening to Donald Trump over the last few days, listening to Howard Lutnick, listening to Scott Bessent, this does not sound like a Trump administration that is in a hurry to strike a deal. Obviously, part of their goal is to reindustrialize the United States. That will require elevated tariffs for a long period of time. For the Europeans, that is exactly the needle that they need to thread. And as a consequence, they need to put as much sort of pressure there, at least put it on the table. Say, these are the measures we're willing to take in order to have these negotiations with the United States, because despite the fact that they want a deal, they still, as Carlos Cuerpo just told us, need to not be naive about Trump's goals here.
Ollie, great stuff. Fantastic conversation earlier. Thank you very much indeed for bringing it to us. We are watching very carefully what is happening with the defence stocks this morning. It is an area where the market appears to be being forced to sell. You just had Leonardo reopening. I think it might be halted again, but it's, when I got a price a moment ago, down by 16.5%.
33 euros per share, just about 34. And following in suit of the massive moves to the downside we've seen with the likes of Rheinmetall, among many, many others. So, of course, seeing quite a bit of pain in the defense stocks, which have been, at least since the start of the year, a real haven given some of the kind of impulse from a lot of European governments to invest and invest big in that defense infrastructure. Let's bring a little bit more context into this tariff narrative and the geopolitical implications. We're joined now by Elvira Fabry, Senior Research Fellow at the Jacques Delors Institute in Paris. Thank you so much for joining us this morning. Walk us through this impulse here. I mean, we see leaders very quickly struggling to have two very different approaches. Do you match tit for tat the tariffs that Donald Trump has put on your administration, or do you take the opposite approach and do you negotiate? What's the right path forward, Elvira?
I think we should make no mistake. There will be a strong response from the European Union. And the European Commission has been engaging already for long into negotiations. And what we have heard those past days from Donald Trump is that he won't move back. I share completely the analysis that was presented just a minute ago. He just told it. He just said on Friday, those tariffs are there for long. He has promised an El Dorado for the U.S. economy. But that the journey will be painful. So we shouldn't expect him to engage much into negotiation. And let's keep in mind that between the US and the EU, there's only 0.5% of difference between tariffs. So the issue is about non-tariff barriers. And this is not something that we can negotiate easily. So I guess for the moment, between the member states, you have ministers that are adjusting their speech. But we shouldn't make, let's not be confused. The EU is preparing a strong response. It has the ability to do it. It's going to be complex. It has to target notably the kind of services. Yes?
Elvira, what should that response look like? What do you think the package should look like right now?
Well, I think there would be a two-phase response. One that will be targeted on the automotive sector, in addition to what was announced for the aluminium and steel and aluminium. But the big package will be for the 20%. And we see directly that we are in an economic coercion field. So the European Union can use its anti-coercion instruments, which allows it to accumulate many different measures. And the big question is how the EU is going to target some US services, which kinds, financial ones, digital ones. I guess we can expect that the big tech firms, US tech firms, will be directly targeted. It will take a couple of weeks, maybe more, maybe a month. That's not the problem. The issue for the Europeans is really to limit the damage on the EU economy. So we can call it a negotiation phase. We can call it like that. And the Europeans remain open to negotiation. But I'm not expecting Washington to engage much more into that negotiation, and I think we can expect that he will not. He will be satisfied with some concession made by other smaller markets, but the confrontation between the US, China, the EU, and countries like the big markets like South Korea, Japan will continue.
Elvira, you mentioned services and you mentioned the tech space as well. I would like to zero in on the services here. What kind of services can Europe, in theory, at least on the table, target when it comes to the United States?
You have all the digital services. You could only by implementing the EU regulations, what is called now the DSA or DMA. The Europeans have they can decide how far they can go in the implementation of those regulations. So you could implement some fines on the digital services because they're not complying with those EU regulations, and we know that Meta has been concerned by those regulations. But as well, you could consider that the anti-coercion instruments would allow as well to reduce the access to the EU market to even to some financial services. Maybe the big US banks.
Well, Elvira, you mentioned the digital services specifically, and I'd like to zero in on that, especially the fines when it comes to like Meta and Apple. Just for the clarity for our global audience and for myself as well, aren't those fines certainly going through court orders and through kind of the European courts as well to talk about that? How quickly can that mechanism be used if that is even something that's accessible from leaders to the court system?
But first, we would have to distinguish that it wouldn't be a retaliation, right? It's only implementation of EU regulation. It would take time. It's the process of EU legal processes. But there's no urgency in a way. The whole problem is rather to have the unity of the member states. And we would need, for those measures, it's only a legal process. But for the additional measures, if we were to target more through the anti-coercion instruments, those digital services, we only need the qualified majority of the member states. But it's about the main issue for the Europeans is really to get that unity between the member states.
Does the WTO matter anymore? Are we in a world where actually WTO rules no longer apply? Is that a useful tool? Is that a useful forum at this point in time? Do I need to abide by WTO rules?
Yes, it's essential. Of course, the US, through the new administration, has signaled that it wasn't following anymore the WTO rules. And the risk is that the concessions that Washington are asking for with their trade partners would crush the respect of the anti-discrimination principle, the pillar of the WTO. But for the rest of the world, for the 87% that continue to, that import in the world, while the US only represents 13%, they want to continue to rely on a stable trade system, and they need to defend that system. So it's meaningful also to have countries around the world that complain at the WTO level and that try to abide by respecting the anti-discrimination principle, and avoiding to make some concessions to the US that they wouldn't do to the rest of the world. But of course, we can consider that the system is really at risk at the moment, and that in addition to have a crash in the markets, we could have a really a completely collapse of the trade system.
Elvira, We'll see what happens. We're watching it tick by tick, moment by moment at the moment. Elvira Fabry, Senior Research Fellow at the Jacques Delors Institute, joining us on the trade story. It is certainly being reflected this morning, what we've just been talking about in the markets. Big sell-off across Asia, now being followed here in Europe. Big bid into the bond market. Certainly we're seeing that. The front end of the German curve is down by 19 basis points this morning. Huge bid. Seeking of safety seems to be the trade this morning.
Seeking of safety, but then where do you hide out? I mean, in this equity market, I'm looking at 7% declines across Europe.
You don't hide out in the equity market.
You can't hide out in the equity market. You can't even hide on the gold market or even in the dollar. Your traditional safe havens don't exist at all. I want to get a quick sector check here, though, because I think this is important. If we're talking about some sort of China fiscal stimulus or some kind of China impulse that's going to have ripple effects, the miners would, in theory, show it. You are not seeing that this morning. This is a global growth story that's hitting that one. The other one I wanted to keep an eye on was luxury stocks, because it's not just a China story there. It is a broader Asia and supply chain story there, and that's going to feed into some of these stocks, which are also taking a beating. Take a look at this Burberry, down 8.3%.
If your stock portfolio is getting hammered, are you going to buy a new Burberry scarf? I joke, but the relationship is not is not one to ignore, and I think that's going to be interesting. The stock I keep coming back to is Nestle. Nestle should be the place you hide out. Nestle is down by 5.5% this morning. Well, people are selling a lot of stuff they wouldn't normally sell.
Anything that has, I think, given some yield, whether it's Nestle, whether it's some of the luxury stocks as well, because they've been outperforming quite a bit alongside defense stocks, you are selling your most profitable companies this morning. That seems to be the theme across the board. We're going to continue to monitor these markets for you when it comes to stocks, bonds, currencies, and, of course, commodities. Right across the screen, this is Bloomberg. Welcome back to the opening trade. 51 minutes into today's session and seeing red on the screen across the board. A 6% decline in the DAX, a 6% decline in the Stoxx 600, and you're continuing to see the pain across the board. Even in the FTSE 100, which isn't selling off as much, still 4.5% declines. If we're looking for some green on the screen, I feel like the FX space is one area we haven't actually talked about, because the dollar is continuing to sell off, and that is creating a bid into the euro and the pound. That is not a sentiment indicator. It is purely fund flows. 110 on euro dollar, 129 on cable. But then again, a continuous bid into the Swissy, a continuous bid into the yen. So there is a move for safe havens, Guy. The dollar is just not one of them.
It's amazing, isn't it? So you de-dollarization process, that is a big signal as to what is going on here. Let's talk about what is going on here in a little bit more detail. We've got a fab team around the desk. Valerie Teitel, Michael Masika, who leads our EMEA equity markets and strategy coverage. Let me start with you, Michael. What are you hearing? What is the talk on the chat rooms this morning about what is going on?
Well, Guy, this is very simple. We're talking capital preservation here. This is what's going on. It's like you sell everywhere you made money. So we see it today in Europe with the defense stocks. We've started seeing it last week with the banks. So all those sectors that have been doing very well, people have been long, very, very long those sectors for several months now, sometimes years. They're selling. You sell everything, just you preserve the capital. That's the reaction. That's what we see. Last week, there was a lot of heavy selling from hedge funds, so that's a classic thing. But long-only asset managers have started selling as well, so this is another type of route, I'd say. So like just another level.
Well, hop on in here. I mean, Masika's calling it another level. Is there any positivity on the horizon that say, okay, this sell-off is too far gone, maybe we can buy the dip?
I don't know. I think maybe the one positive is that the market is still functioning well. At least we saw that on Friday. The S&P 500 futures, the volumes were surprisingly large. Like the market is really taking this well. And maybe we can tie that to what happened during COVID when the Treasury market completely blew up and wasn't functioning. And that was the first kicker for the Fed to come in and save the day. It doesn't seem like we're headed towards some period of destabilization, at least in the Treasury Treasury market or in the equity market for now. But that maybe could be what could prompt maybe some emergency measures from the Fed. But even Scott Bessent was talking on Friday with his interview with Tucker Carlson, saying that the American people should be reassured by the fact that the market functioning and market liquidity is still doing okay.
Okay, let's talk about the American people. How's retail doing?
Well, yeah, that's the cohort that haven't started selling yet. So I was saying hedge funds have been selling for now several weeks. You had long-only asset managers. They've started selling, like especially heavily last week. They might keep selling now just to preserve capital. The cohort that still is very, very, very long and that hasn't started selling is the retail. That's according to Goldman Sachs prime brokerage desk. So when they start selling, then we might see another leg down, really, if they decide to. So that's the tricky part. If.
So no one look at your 401ks is what I'm hearing. Over the weekend, we kept hearing this idea that the market is over-levered and that there are already margin calls in place. Are you seeing evidence of that this market is over-levered?
So we don't see evidence of that, but that's what the prime brokerage desks are saying. The leverage was very, very, very high coming into this. So now there's a huge deleveraging happening. Some strategists and traders were trying to assess, okay, where this is going, where are we getting with the S&P 500? If you look at the past episodes of large sell-offs over the past 6-7 years, the S&P 500 started bottoming out between 13 and 15 times forward PE. We're still at 18. So if you assess that and okay, where is the bottom, then maybe that's your target there.
18 from 23 though, right? So that's some, you got to give it credit. That's some progress in terms of a decrease in valuation.
Yes, that's a big in progress. But again, if your global growth is now priced to be zero or even negative, well, then that tells you also where the S&P is going.
Val, what's my North Star this morning? What am I looking at? What's guiding me? Is it credit spreads? Is it what people are selling? Kind of just give me some sense of direction.
To me, this morning, it's developed market credit spreads. I think that's what led the banks to take a step lower, and that's what's leading, this market wobble is really this blowout in high yield. A little bit of wobble. But, I think, Guy, there are still some really big picture questions for the market to tussle over. What exactly does the economic world, does the market look like if the trade deficit of the U.S. is narrowed? And to that, guys, can you actually have an overvalued equity market without this trade deficit? I think that's another question that people are thinking about.
You would have thought theoretically what happens with the capital. That's the dollar story. Is the dollar the North Star? That I think is an interesting question.
I mean, to me, the dollar is a North Star in terms of the market trying to figure out which economy is going to be hurt worse out of this, right? If the euro is rallying, maybe that's telling us that Europe will be hurt less than the U.S.
Bloomberg's Michael Masika, Valerie Teitel walking us through these markets. Folks, we're seeing red on the screen across the board. Some marginal positivity in the euro, but let's see how long that holds. That does it for the opening trade. The Pulse is up next. This is Bloomberg.